Street is underinvested in energy. There's a distinct gap between the spot price of oil and energy equities itself. That's going to close. Spot price of oil is going to continue to move higher through the remainder of the year. It's developing a very bullish trend, in particular globally, which would be Brent crude oil, energy equities relative to the spot price of oil. The gap's going to close. Energy equities, increase the exposure. That's what I'm doing.
Because Brent's up, what, 4.5% in some 5 days. WTI is up 3%. So I mean, it is moving higher. At what point, though, is it, Steph, a headwind?
Well, I mean, I look at energy, I look at inflation. I worry about those two things a lot, right? And obviously rates as well.
Two biggest risks right now?
I think it is oil, and I think it is interest rates for sure. I always worry about the international growth, too, but we are starting to at least see a stabilization. But what I would say this, we got some really good data today again. Again, we got good data. The Richmond Fed number really surprised to the upside. That was very impressive. Consumer confidence, the best in September of 2000. So you kind of can't just look at two data points and two pieces and get worried. You got to have to look at this whole thing collectively. And at 17 times forward estimates, I think we're at a pretty attractive place in the market given where the economic growth is.
Okay, Josh, let's take one at a time. Oil. Do you see it as a headwind? We're north of $72. It's been moving up. It dipped into the red a bit on the president's speech here in New York at the UN. But the trend, at least lately, has been up.
Sometimes I think I live in alternate reality where only I have any memory of the last 5 years. We had an earnings recession, Judge. That was the headwind. You know what caused it? Not rising oil, collapsing oil. So I don't think anyone wants to pay $5 at the pump. We're a long way away from there. If you ask me, what would you prefer? Rising energy, I would ask, why is it rising? And Joe would say, consumption, not enough supply, whatever. I would say, all right, that sounds like it's a good thing for S&P earnings. Doesn't sound like it's a kind of thing that's going to lead to another period like 2015, 2016, where earnings flatline or decline and the median stock declines by 25%. So this is the opposite scenario. Economic growth is good. Oil demand is growing. Oil supply is coming online slower than demand, so we've got slightly rising prices.
Okay.
There were some amazing, to echo Joe's point, there were some amazing charts in the energy sector for the first time in a while. He showed me HES yesterday. Look at this breakout, HES.
So give me the other side of it then. Rising rates, 310 on the 10-year. At what point is that a headwind for stocks? You heard Leisman with the CNBC survey saying, you know, the people that they ask, the majority expect stocks and bonds to go up together.
Well, let's look at correlations of rates and stocks over the last 18 months. The yield on the 2-year has doubled. Is that right? Okay, and the S&P has gone up 60% in the same period, 50% in the same period of time. So I'm not sure why we would say that rates rising is negative equities when we've just lived through a period where it's the exact opposite. In the 1950s, interest rates rose steadily. Stocks had the best decade in history. In the 1990s, rates rose. Stocks had their second best decade in history. So again, you want to tell me rates are rising, unless you tell me it's because of an inflationary crisis, then I'm not going to tell you, oh, that's a reason for stocks to have a lot of trouble.